The Guarantee Company of North America hosted a roundtable recently, examining the Canadian credit insurance market. This is the second of a three-part series featuring a discussion on how to better manage risk and grow sales in this often overlooked insurance segment. Moderated by John Middleton, President of Global Credit Risk Management Incorporated, panelists were asked what considerations are taken into account to manage risk from an underwriting perspective.
From the underwriting point of view, what I can say is when it comes to the credit manager, we have one of our largest clients is we work very closely with the credit manager there and the credit insurance product and the broker to complement what they already have in place. A typical example would be they will call us and they will say, we are not comfortable getting into this market. It's a new market to them. So the credit manager will be working with the credit manager and with the broker for the client to access a new market for the next 3 to 4 years until they're comfortable in that market, and then they take on that market themselves. So it is a very complementing product to the bigger clients. And what we're doing for the underwriting process, a lot of time we do our due diligence on the credit group, on the credit department, the credit manager and the authority level there. And we typically give a bigger discretion limit for the client to take on their own limit, and we'll ensure that limit that they've even agreed upon to their own client. So there is a level of due diligence we do to the larger client where there's a credit department in place.
So what you're saying is that for the larger customers, you're actually underwriting their credit management processes, not so much their buyers, but the approach that they take to managing credit?
We do, that's the step one for the smaller limit. The larger limits, we'll always underwrite that limit, but for the smaller limit, if we're comfortable with the credit management process within the client, they will have the ability to take on those decisions themselves up to $100,000, $200,000, and we will ensure that.
One thing you have to really be certain about when you're talking to these small and medium-sized customers, though, is that they're actually truthful in what they actually do from a credit perspective. Whether they actually get a credit application filled in, whether they actually go out and get bank and trade references. Because I've seen numerous times where claims have been denied, not necessarily on my clients, because when they filled in the application for credit insurance, they didn't fill it in truthfully. They said they were going to do something, but generally speaking, they didn't. And that's one of the key issues that a broker can bring to a client is that make sure that they're being truthful, and then you can, as a broker, go and sell that to the insurer as that this is what they actually do, and it gets written into their policy.
I want to step back for a second and just talk about some other opportunities for this product in terms of helping companies grow their sales and be more successful. And I just wondered if any of you have had opportunities to help a company perhaps chase a sale and win a sale that maybe they wouldn't have had if they didn't have the opportunity to do it with credit insurance as a backstop. Have you ever encountered situations like that where you've been able to use this product to help the client get to the next step, take the next step, grow their business? Any thoughts on that?
Well, me and Jay were talking about something not that long, a couple of minutes ago, let's say. You can use this product to get a leg up on your competitors. So if your clients are maybe restricting their terms, dealing in export markets where they're very restrictive, or dealing with LCs, you can help them get away from those restrictive terms, open up terms to new clients, and get a leg up on the competitor. What we were doing for one client was they were selling at 30 days. They wanted to try and extend better terms, so longer terms. Yep. So what we did was we were able to put terms in place over and above the 30, so it's 60 days, so he could sell at 60 days to his client. And I don't know if you want to touch a bit on that.
Yeah, that was a perfect example where it gave the client a competitive edge, where the client was not competitive within his own space, selling on 30-day terms when everybody's selling on 60-day term. By adding credit insurance with the help of the broker, we increased the term from 30 to 60, and the client actually grew. So that's a prime example when it was not only used for risk mitigation, it was used for risk mitigation to increase the sales and for margining purposes.
Look for part 3 of the roundtable. Are brokers ready to step into the advisor role?